calls, puts, spreads, and more, all explained so you can know your options.
Here with me now to help you know your options, equity strategist and options expert, if I want to use that word, David Borun. And you really follow the options market fairly closely, so you're real conversant with a lot of the strategies that are out there.
Absolutely.
So you're a good person to tap into knowledge-wise when it comes to this. But I have to ask, you're going to talk about closing option trades, right?
That's correct.
So we begin at the end instead of at the beginning?
We begin at the end because I think it's an often overlooked part of people's option strategy. The legendary trader George Soros once said, it's not how often you're right or wrong, it's how much you make when you're right and how much you lose when you're wrong. And with regard to trades, people spend a lot of time initiating a trade, deciding on what they want to do, and maybe don't pay so much attention to how much extra money they can make or how much they can save themselves by closing more effectively.
So is this a fairly simple trade?
Yes, I chose an extremely simple trade as an example here so that we can discuss some of the options you might have for closing options.
All right, let's get started.
Absolutely. So I chose a simple call purchase in Papa John's. So an investor might buy a call as a leverage bet on the direction of a stock. In this case, this is a stock that I don't particularly love. I probably wouldn't want to own outright, but because there are rumors of a potential takeover coming, I might want to risk a little money on a call option so that if the stock does rally, I can make a little something.
So far, sounds relatively simple.
It does.
What's next?
So I bought my option. You can see that I've got a limited risk. I'm paying $1.75 or $175 per option, and I've got potentially unlimited upside if the stock were to rally sharply. There's basically three possibilities. The stock can stay the same or drop, in which case my option is going to expire worthless. It was an unsuccessful trade. The stock could rally a little bit, put me a little bit in the money, and then give me a decision about whether I want to ride it to expiration or close it. Or the stock could rally exactly the way I'm expecting sharply, and now I've got an option that basically becomes a 100 delta in the money option.
So far making sense. You're cutting losses when the trade doesn't work as you expect it to. What about when it's profitable?
Well, so when it's a little bit profitable, I want to decide whether I'm going to sell that option while it still has some time value.
Okay.
So in this case, because I already said I'm not particularly interested in owning this stock, I'm probably going to sell the option when I've got a little bit of a profit in it before it goes to expiration and becomes worthless or near worthless.
So at this point, there's still some value in that call option?
Absolutely. So there's still time value in the call. Even if it's only a little bit in the money, there's still some time premium left in it, and that's what I'm going to try to grab when I sell it before it expires.
Okay.
Now let's say that the stock rallies considerably. So in this case, I bought a 60 strike call. We're going to say the stock rallies to $72. In that case, I've got an option that now has $12 in the money and is probably a 100 delta. It's going to be trading just like the stock. So for little moves right now, my long option is essentially the same as a long position in the stock.
Okay.
So if I want to try to grab that profit, I can either just sell the option, which is fine, and I've just locked in a profit. I paid $1.75, I sold it at $12. Excellent trade. But I'm also giving up all the optionality of that option. There's actually a little piece left that I can lock in if I do a different trade.
Okay. So far you're on the bullish side of the equation.
I am. Well, this is the trade that's worked out well for me, but I want to make sure that I maximize my profits on the trades that have worked out well. So instead of selling the option, I'm going to sell 100 shares of stock.
Okay.
Now in this case, that I have a position where I've still locked in my profit, $12 minus $1.75 I paid, but I essentially own the 60 put for free at that point. And that sounds a little counterintuitive, but I can explain it. If I'm short the stock at 72 and I have the right to buy it at 60, I know for certain that I can't lose on that trade. It's locked in. That's the worst I can get.
Okay.
But if the stock were to fall below 60 before expiration, I don't have to exercise that call and buy the stock back for 60. I can buy it in the market at a lower price and keep the additional difference as profit. So if the stock were to go to $55 below the 60 strike, I don't exercise the call, and I add $500 in profit to my trade.
That would be the bearish scenario.
Sure. Well, if I got the bullish move followed by the bearish, if I got the bullish move, I can close the trade and keep it. But if I close the trade a little smarter, I can also keep some profit opportunity if the bearish situation happens.
Okay. What else we got?
That's pretty much it. I just would kind of like to point out to people that if you analyze the way you close trades, you can often make little bits of extra money, and the most successful professional traders never leave anything on the table intentionally.
All right, and never take ownership of the underlying cash stock, right?
Generally not, unless you want to. I mean, so there may
Right.
be a situation where you want to own the stock, and that might be an opportunity for you to simply let the option expire in the money, and you take delivery of the stock.
Sure.
One more thing real quick, Terry, I'd like to say to our viewers is that some of the trades I've described are a little more complicated than average, especially selling short. So I would encourage anyone to discuss with their brokerage firm exactly what the capital margin requirements are, what their trading privileges are before they initiate a trade, so you don't get surprised that you can't do the consequent trade.
Start with the basics before you get off into the iron condor territory and all those more complicated ones, right?
You got it.
Dave, thanks a lot. You can also see different articles on options and other topics by David on our website, Zacks.com. So get on over there and start looking for them. They're there regularly. David writes for the website on a regular basis. With David, I'm Terry Ruffalo.